Hi, welcome back. It's Mark Fielding Pritchard from ME Fieldings here, and I'm talking very, very slowly because I have to remember that the last video we did was on currency futures. I keep forgetting what the last video was when we get to that point. Right, as I said, my name's Mark. I come from ME Fielding Company. We specialise in offshore tax and so on for people who are looking to move money around. We get a great deal of questions from our clients, and also now increasingly coming to the Facebook page and the website and so on, about hedging. So we did foreign currency futures, let's get that right. We did that, it was before Christmas, so you can see the effect Christmas and New Year's has on me. And we got asked if we would do a video on interest rate futures. So here is a video which is kind of aimed at ACCA, ICAW students, because we tend to use exam questions as the basis, because they will give you a basic understanding. If anybody does want more detail beyond how the thing actually particularly works in practice, please send us the question. If you're watching this and you think this is the wrong thing, or if you're watching this and you think this is the right thing, but you have some friends, please like us on Facebook, please subscribe to the channel, please invite your friends, etc., etc. All the things that all the websites do. Right, let's get into interest rate futures then. Right, what's going to happen therefore is that we have a company, certainly in exam questions and almost certainly in real life, at the sums of money that make this worthwhile, it will always be a company. So we have the situation where we have a company and the company is going to take out a loan. The risk therefore, remember at this kind of level in ACCA and so on, you're looking at risks. The risk therefore is that interest rates will rise. And if interest rates rise, what will happen is that you are going to have to pay additional interest. Now let's just have a look at the slide, because there's two things I want to say at this point. Bearing in mind, we have a company, and the company is going, at some point in the future, to take out a loan. Now the first point here really relates much more to ACCA questions, and I guess ICAW as well. But the assumption that you should always be looking to make in ACCA questions is that the loan, when it's taken out, will be fixed rate. Can you see therefore at that point your risk ends, your risk of rising interest rates ends, and you may pay too much interest. But the basic point is that your risk is that interest rates rise between today and the date on which the loan is taken out. Once the loan is taken out, the risk ends. Now, in real life, or in scenarios where the loan is floating rate, that will not be the case, because that will continue to exist. But for exam questions, you should make that basic assumption. So that your risk period is from today, the date that you're given in the question, to the date when the loan is taken out. When the loan is taken out, it will be fixed rate. That's the first thing. The second thing is that these things are futures. We'll come on to the next slide and I'll explain to you how they work. It's much easier to explain how they work with an example in front of you, because then it kind of makes more sense rather than a kind of esoteric explanation. But you need to have as a point of principle in the back of your mind. For exam questions, we're almost certainly looking at LIFE. LIFE is the London International Financial Futures Exchange. Life is nothing more and nothing less than a casino. Okay, so you go along to the casino, you put your chip down on black, and if black comes in, you win a sum of money. Therefore, how does the casino work in real life as far as interest rates are concerned? If your concern is that interest rates will rise, what you do is you bet, and it's nothing more than William Hill's this, you bet that interest rates will rise. If interest rates do rise, you win your bet, and the sum of money that you win in your casino is equal to the additional interest that you will have to pay on your loan. Okay? If you can get that process straight in your head, these questions are actually very easy. Assuming that we're talking about exam questions here, a lot of people steer clear of interest rates and futures and currency futures as well. They're actually very, very simple. Now, what we tend to find as well is that students who get fancy expensive classes realise that they're easy because they have a very good tutor who teaches them, and they go in the exam and do them well. Students studying at home, trying to teach themselves, find it incredibly difficult. And they tend to avoid the questions in the exam, and it's a shame, because it's a question that you can actually do, and you can get it exactly right. You know, you can get 20 out of 20 with this, and it's really not that difficult if you learn how to do it. Right, let's start with our points of principle. Firstly, you're going to a casino, assuming that your concern is that interest rates rise. You simply bet that interest rates rise. The money you win in the casino covers your additional interest. That's the first thing. The second thing is that certainly if it's an ACCA question, when the loan is taken out, make the assumption that the loan is a fixed rate loan, because if it's a fixed rate loan, your risk ends at that point. So your risk period is from today being given to you in the question, up to the date when the loan is taken out. Okay, if you have any questions on this stuff, go to the website, we're mefielding.com, send us a question. That's by far the best way to do it, and that's how most people get in touch. Right, let's move on and look at an example then, because it's much easier to do this with an example than it is with talking about the theory. Right, so let's just have a wee look at a question. We have a company here, and it tells you that the company needs to borrow £10 million, and notice that we've doing everything here in pounds. Your ACCA questions on this subject are normally done in pounds as well, and that makes it nice and easy, because if we're using life, all of our profits, all of our losses, all of our premiums and so on will all be in UK pounds, because life is in London. So we're not introducing an element of currency into this. Right, it tells us that Ben wants to borrow £10 million for 2 months from the 20th of April. So we'll take the loan out on the 20th of April, and then it will be repayable on the 20th of June. Yeah? And the interest as of today being the 31st of January, is 5%. Right, notice as well that 5% is given to you. That will always be given to you as an annual rate of interest. Okay, so the bank's telling you it's 5% per annum. So 2 months is obviously 1/6 of that. So that's your basic situation. We're going to use some futures in life in the London International Market. Please notice that at life you cannot borrow money. So therefore we'll borrow the money from our bank, and then we'll have to take the hit from the bank. So you've got two separate and distinct transactions. One is the borrowing, repaying of the money. That's one transaction, one business, whatever action, and the second one is hedging, which will be completely separate and completely different. So it tells us that they presumably is BUABM, decide to hedge their risk by using 3-month interest rate futures, which are currently quoted at. Right, for now, don't worry about it too much, but do notice that thing there that says 3-month interest rate futures. Interest rate futures come in various sizes and various time periods, and they don't absolutely have to be 3 months. So we'll come back to the significance of 3 months when we come on to the next slide. You are then given two prices, so you have March and June, and usually in ACCA, ICAW they'll give you 2 or 3. Notice therefore that these things are given as months, so a March price is 94.5 and a June price is 94.85. Right, what's happening to us here therefore is that the month tells us the month in which they close. So in other words, a March interest rate future will close in March. Now as far as the exam is concerned, the examiner usually tells you to assume that they close at the end of the month. Right, close means therefore that between today, which is the 31st of January, and March, we'll assume it's the 31st of March, in real life it won't be, but we'll assume it's the 31st of March, you must do two things. You must both buy and sell. So you can either buy now and sell in the future, or you can sell now and buy back in the future. Now students sometimes have this kind of question, how can we sell something that we don't own? Just think of it as a process. Don't worry about that. Because what's going to happen is you're going to have to buy them back anyway. All that is we're saying here is that in some given period of time, you must buy and sell. And it doesn't matter what order you do them in. The reason is because your gains or your losses will be based on the margin. In other words, the difference between the buying and selling price. And we'll calculate that at the 31st of March. If it's June, you have a wee bit longer. So now you can buy or sell today, and you have until the 30th of June to buy or sell. Right, all I want you to understand so far is this idea of the month. And in reality, if now is the 31st of January, assuming it's 2014, you'll have March 2014, June, September, December 2014, and you'll have March 2015. So typically you have at any one point in time 5 futures which are being quoted on the market. We're given a price. We'll come back to the price in a minute. It tells us here contract size is £500,000. That's still relevant. Please notice that these are pounds. If you're on life and you're dealing in euros, for example, contract size would be €1,000,000. And then you're given some piece of information so that you can calculate the value of these things. At the 20th of April, futures price has moved to 94.25 and the base rate of interest has risen to 5.25. Right, it says the futures price moved at the 20th of April to 94.25. Please notice that must be a June future. It can't be a March future because the March future has closed. It's gone. The March future doesn't exist at the 20th of April, so it must be a June future. Okay, that's your basic information. I just want you to be comfortable with that for now. When we go deeper into the calculations, then we'll look at exactly what all of that means. So what we're going to do first is we're going to create the hedge. Remember that the company has 2 distinct and separate transactions. Transaction 1 will be borrowing the money from the bank and therefore subsequently repaying it. So that's transaction number 1. Transaction number 2 is creating the hedge. And creating the hedge is saying, right, okay, with these futures, which ones do I need, how many do I buy and sell, and what do I do with them? So in other words, it's this idea of going into your casino and putting your chips down. And that's what we're looking at now, setting up the hedge. Now those of you who went through the foreign currency video will see that the process is exactly the same. As far as the process goes, we need to ask ourselves 3 questions. So the 3 questions are, do I buy or sell, which month, and how many? And that's what we're going to go through now. So question number 1, do I buy or sell? Right, to make this decision, you need to know 2 things. One of them we've already covered, so point B on the slide. You need to understand that in any given time, you must either buy and then sell, or sell and then buy. And it doesn't matter as far as the exchange is concerned. It does matter very much for the hedge, but it doesn't matter as far as the exchange is concerned which way around you do those things. Because they will take a point in time in the future, and at that point they will say you sold for that price, you bought for that price, what's the difference? And the difference is your gain or your loss. And then we'll show you how to calculate that. So that's number 1. That's point B on your slide. You must sell and buy, or buy and sell. Right, number 2. Futures are valued at 100% minus interest rates. Right, I know your immediate question is 100% of what? But take it from me now and I'll explain to that to you when we do the calculation of gains and losses. Futures are valued at 100 minus interest rates. Therefore, what we would expect on the 31st of January, assuming that Boabin can borrow at LIBOR, LIBOR is the London Interbank Offer Rate, we would expect a future to be valued at 95. Why 95? Because it's 100, which is the base point, minus interest rates. And assuming that Boabin can borrow at LIBOR, we're told that the rate of interest is 5%. So 100 minus 5 is 95. Now, in fact, the value of futures is not 95, it's 94.85 as I remember. So therefore, at that price, it's telling you that the market is expecting interest rates to rise. Yep. Does everybody see why we're expecting it to rise? Because the price of a future on the 31st of January is not 95, it's less than 95, which means that interest rates are going to be greater than 5%. Right. Futures are valued at 100 minus interest rates. Right, take a deep breath. Hope you've got those 2 points. Right, now what do they tell you? They tell you, therefore, that if we are hedging rising interest rates, on the 31st of January, we will sell. Right, why do we sell on the 31st of January? We sell because if interest rates are 5%, ignoring basis risk, the value of the future will be 95. So we sell at 95. If interest rates rise to 6%, the value of your future will fall to 94. 100 minus 6 is 94. You sold at 95, you buy back at 94. So therefore, you have a gain of 1. Okay? So, do I buy or sell? If you don't understand it, we'll look at it on the next slide, but also you can just learn it. If you're hedging rising interest rates, you sell first and buy back. Similarly, if you're hedging falling interest rates, because you've got money on deposit, you will buy first and then you will sell in the future. Okay? Hedging rising interest rates, we sell. Move on to the next slide. So, question number 1. Do we buy or sell? Let's just cover this again, because this is something that students always struggle with. In fact, usually the thing they struggle with most is the concept that you can sell something and then buy it back. But take it from me, you can. You just need to accept. So futures are valued at 100 minus the interest rates. Therefore, if we are hedging rising interest rates, we sell. If interest rates rise from 4% to 5%, the value of a future will fall from 96 to 95. We sell at 96, we buy at 95, we have a profit of 1. I hope that that is fairly straightforward. When you look at it like that, very, very simple mathematics. Nice line, of course, we have a profit of 1. Brilliant. Profit. Cigars and champagne, but a profit of 1 what? And we'll come back and look at the calculation of what a profit of 1 means in a minute. For now, all you're trying to decide is, do I buy or do I sell? If you are hedging rising interest rates, you sell. Okay? So in our question is we sell futures and buy back later. We will go to the market, we will sell futures on the 31st of January, and we will buy them back on the 20th of April when our risk disappears because we take out the risk. So question number 1, do we buy or sell? We sell. Question number 2, which month? Right, which month is very, very easy in this question. You're given 2 futures. You can't use March because your March future closes on the 31st of March. In fact, in real life, it'll close on the 3rd Wednesday of the month, so it'll be before that. That would mean that you were unhedged against interest rate rises from the 31st of March through to the 20th of April. So therefore, we have to take a June future. Now, as the slide says, if in the question we were quoted September futures, we would still use June, because June will give us as close a value as we can get. Right, what on earth does that mean? It will give us as close a value. Your risk ends on the 20th of April. Now what will happen on the 20th of April is that, and you've already seen this, is that the movement in the future price will not exactly match the movement in interest rates. And the reason for that is that the trader has a risk and an expectation of what will happen in future time. In other words, your future on the 20th of April still has another 2 months to run. So your trader therefore will factor into his price what he thinks is going to happen over the next 2 months. That factoring will change the value of the future, will move it away from exact movements in interest rates. Can you see that this difference between interest rates and futures price will be bigger and bigger and bigger the longer the period of time is until the future ends? Right, that's called basis risk. It's this idea that, and we saw it at the start, interest rates are 5%, so our future should have a value of 95. But it doesn't. It has a value of 94.85. So there's a difference of 15 basis points, or 0.15%. there. Right, why does that difference exist? That difference exists because the trader is factoring into his pricing what he thinks is going to happen until the future closes. The longer the period of time is until the future closes, the greater will be that difference. If it was a September future, it wouldn't be 15 basis points, 0.15%. It would be much greater. Therefore, we take the future which closes first after we take out the loan. So we take out the loan on the 20th of April and we take the June future, because then we're fully hedged and the basis risk will be a minimum. Right, if you have any questions on that, it's a wee bit complicated, send me a question and I'll answer it for you. But in terms of what we're doing, we're setting up the hedge now. We know we are going to sell June futures. Okay? So remember we said that there were 3 questions. Do we buy or sell which month and how many? First question answered, we sell. Second question answered, June. Third question will be on the next slide, and that is how many. Okay, when we went through the slides and we went through the information on the question, we talked in very, very general terms about, well, the value is 100% minus the interest rate. And we talked about the fact that contracts were a certain size and that these were futures and da-da-da-da. When you get to question number 3, you've answered the first 2. We're going to sell June futures. Now you have to understand what this information is actually telling you. Remember your basic premise. Your basic premise is that you are going into a casino, and in your casino you are winning a sum of money. So your future is the equivalent to a chip. Right, well those of you who've been in casinos will know that there are different chips and they have different values. Right, go back to the slides and look at see what it tells you. It tells you that the value is 100% minus the interest rate. So it must be 100% of something. So we have to ascribe a value to that chip. And that was what the information in the question was telling you. It's telling you that contract size is £500,000. So in other words, therefore, the chip has a 500,000 principal value. And it's also telling you that the interest rate futures are 3-month futures. Right, what does that mean? It means that if you bet on interest rates to rise, and they do rise, each chip will win you enough money to cover the additional interest on a loan of £500,000 for a period of 3 months. So each chip gives you enough interest to pay your extra interest on a loan of £500,000 for 3 months. Now that's all given to you in the question. The 500,000 is called your contract size, and you are told that they are 3-month interest rate futures. You do need to get this clear in your head, because if you're dealing with futures which are in a different currency, so if you're dealing with dollars or euros, for example, excuse me, they are usually quoted, certainly on life they're quoted as contract size of 1 million units, so a million euros. And in addition, not all futures are 3-month futures. These are just the ones that the examiner seems to like. But you get futures for other periods of time. And remember that not all exchanges are in London either. There's exchanges all over the world trading these things. So, one chip covers your interest on a loan of 500,000 for a period of 3 months. Please, 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 you must understand, there is no concept either of timing with this. Therefore, let's assume that our company was borrowing £1 million for 3 months. They would need 2 chips, because you get twice as much interest. Please don't run through your head anything to do with timing or anything like that. It's very, very simply that we're looking at twice as much interest, so we need twice as many chips. Similarly, if you're borrowing 500,000 for 6 months, the interest will be twice as much. So you need 2 chips. Get that straight in your head and you'll be absolutely fine. Right, let's move on and go back to our question now. So, it's actually very simple, therefore. There's a nice little formula you can use. Assuming that you've got these 500,000 contracts for a period of 3 months. To calculate the number of futures that you need, therefore, put the numbers into the formula. Your formula is your second line down, the principal of the loan divided by 500,000 multiplied by the period of the loan in months divided by 3. And that will give you the number of futures that you need to buy or sell. So our company here wanted 10 million for 2 months. So therefore the additional interest that will be matched by the contracts, in other words, how many contracts do we need, is 10 million divided by 500,000 multiplied by 2 months divided by 3 months. Have a look at that formula. That will tell you your number of contracts. Very, very simple, and if you learn that formula, it will always work for you. So we've got 10 million that we need for 2 months. So it's 10 million divided by 500,000 multiplied by 2 over 3. I haven't got a calculator with me, but from memory, when you do that calculation, you come up with 13 1/3. So it doesn't give you an exact number. Right, you cannot buy or sell parts of contracts. So therefore you round it to the nearest. So if it had been 13 2/3, you would have rounded it up to 14. So that you would have been over hedged by 1/3 of a contract. As it is here now, you are under hedged by 1/3 of a contract. So the principal of the loans in your chips does not match the principal of your loans that you're actually borrowing. Right. That will calculate for you your number. Look at your strategy therefore. On the 31st of January, we sell 13 June contracts. On the 20th of April, we go into the market and we buy 13 June contracts. You must buy the same month and you must buy the same number. Assuming that you do that, what will happen is that the exchange itself will automatically match your position and it will close you out. And then it will tell you whether or not you have a gain or a loss. Okay? Right, that's your strategy. For those of you doing ACCA, ICAW, the biggest chunk of the marks are for setting up the hedge. And you should be able to do that. You know, if you do half a dozen of these questions, it'll just be second nature. So do that. Now we're going to look on the next slide at what the financial result of all of that is. Okay, I'm terribly sorry. I seem to have acquired a sore throat and a cough between slides number 7 and 8. Right, that 4167, and please check that the maths is right. If it's wrong, send me an email. That is the additional interest which Bourbon has to pay to the bank. Nothing to do with futures or anything else. Right, that's our interest. Now the counter side of this, therefore, is that we now go to our second transaction, which was the setting up. If you remember, we sold 13 futures. So on the 31st of January, go back and check these numbers for me, but on the 31st of January, the price of an interest rate future was 9485. So that's given to you on the slide. The price on the 31st of January was 9485, and we will have sold at 9485. On the 20th of April, these are June futures. You have to go back into the market and buy them. So the price at that date was 9425. So we've sold at 9485 and we bought at 9425. So we have a gain. And we have a gain of 60. And we call those things ticks. These date back to the Middle Ages, when these things were used for buying and selling farm produce, and they used to make ticks on boards as they changed price. So we get this gain of 60 ticks. So fantastic. Champagne and cigars and so on, we have a gain of 60 ticks. But what does a tick actually mean? Right, well have a look therefore at what they are. 9485. Remember that the price is 100 minus the interest rate. So in fact, even though it's usually quoted, if you go online, it'll see it quoted as 9485. It means 94.85. Yep, so 94.85. Right, one tick therefore, because these are percentages, so it's 94.85%. So one tick equals 0.01 of a percent. Everybody okay where 0.01 of a percent comes from? We sold, the price was 94.85%. We bought at 94.25%. So our gain is 60. But it's 0.6 of a percent, which is equal to 60 ticks. Yep. One tick, therefore, 0.01 of a percent. Now remember, it's a loan of 500,000 for 3 months, so we get tick value of £12.50. £12.50 is 0.01 of a percent multiplied by 500,000 multiplied by 312. Right, in the exam, the examiner will usually give you the tick price, so you don't need to do that calculation. In ACC and ICAW, they give you tick price usually. So your tick price is £12.50. Right, but remember that you need to know what that means. So you need to be able to calculate that your gain is 60 ticks. So make sure that you're comfortable with that. Again, if you have any questions, please send me an email and I'll go through the pricing with you. So your gain therefore is £12.50. Right, £12.50 is the gain of one tick, but we didn't have a gain of one tick, we had a gain of 60 ticks. So you multiply your £12.50 by 60, gives you the gain. Right, that's the gain on each of your futures. But we sold and bought back 13 futures. So you get to multiply it by 13. Your gain, therefore, is 9,750. Right, that is how it's calculated in real life, and that's the best way to present it in the exam, because that's what your examiner wants to see. If you find it easier to do another way, then you can show it the way that it is on the slide at the bottom. Okay? So therefore it's 0.6 of a percent times 500,000 times 3 over 12 times 13. And that will give you 9,750 as well. Right, please work through that. You need to get comfortable with your ticks, and you need to get comfortable therefore with the calculations of your gains and losses. To be quite honest, it's not much use if you can't calculate your gains and your losses, because you don't know how much money you've made there. So look at our hedge efficiency therefore. The gain on the hedge, the gain on the futures was 9,750. The loss, which is the extra interest we've got to pay, is 4,167. So we get hedge efficiency of 234%. 234% is very good. It looks very, very good. However, in terms of what the ultimate objective of the exercise was, the objective is to get it as close to 100% as we possibly can. So nice, I guess, for the Treasury Department. They've made a wee bit of a profit there. But the question is why is it not 100%? Well, there's two reasons here, and this will be very, very common in real life. The first thing is the rounding of the contract. It says here on the slide that the loan is for 2 months, not 3 months. But the real reason is the fact that we had 13.3 is the number of contracts that we actually required. Can you see therefore that the effect is that the principal of the loan is different from the principal of the futures contracts? And so therefore, even if price movements are exactly the same, you would get a difference there, because your hedge in the futures market is not based on the same borrowing sum as you've actually borrowed. It's different because you've got this rounding of contracts, and that will cause a difference. The second thing here is the difference in price movement, and that's what's really hit this thing. Interest rates only moved 0.25%, but the futures price moved 0.65%. That's a big, big movement in a futures price over 2 months, actually. I have to be honest, I stole this question from another training company. And that's a big, big movement. You wouldn't expect to see that kind of difference in a 2-month period, you would hope. But the point is the same here, therefore, that the price movement, the interest rates moved by a different amount from the futures price. And that again, therefore, will give you your difference. Now here you were lucky, it moved in your favour, but it might not. It might just not move at all, in which case you would have had a loss. Potentially a loss. So those are the things. Those are the things there that you need to note that will cause differences. Now we've got other factors here as well, which are in fact other costs. I do suggest that you watch the foreign currency futures video because it goes into these things in much more detail. Because you should know what these things are. The fees for interest rate futures are effectively exactly the same as they are for foreign currency futures. So we talk about fees here. What kind of fees have you got? Well, when you want to go trading in the market, you have to have an agent. You don't just open up your screen and bash away. Now, having said that, the number of agents, the fees have gone down a lot with the advent of the internet and so on. But you have to pay an agent fees. So in fact, your gain here, and then when you calculate hedge efficiency, you ignore all of this stuff. But in real life, your 9,750 you wouldn't have got because your agent would have taken a chunk of that. In addition to that, once you've got your agent, you have to put a certain sum of money on deposit. It's usually something about, for the first time traders anyway, it'd be about 0.2, 0.3% of the principal of the futures. So 0.2, 0.3% of just over 10 million. As you get a better reputation, you'll find that the level of your deposits goes down. So you've got your deposits, and then what will happen is that if you're losing, and it's not relevant here, but in real life, if you're losing, then what will happen is that your agent every day will be taking money from that deposit and transferring it into a separate account. The reason is that we keep our losses in separate accounts so that you can't go, oh, I've got a loss on this and just disappear. It's to protect the trader, to make sure that if he has profits, i.e. you have losses, that he knows he's going to get paid as well. Any interest that arises on those deposits is yours, but it's not going to be much interest in this day and age. And we call them margin calls because this has to be done daily. You have to pay your daily losses across. That's something that you pay your agent for. Margin maintenance requirements as well. If you are losing, what will happen is that the value of your deposit will decline and decline and decline. Your agent will set a thing which is normally called stop loss or trailing stop losses. When your deposit has diminished by usually something about a third to a half, he will come and say to you, do you want me to just close your positions? If you say no, keep going, you'll have to give him more money to top up your deposit. And that's called a maintenance requirement. Right, you should have a fairly limited but some idea of what those things are. The effect of those things is that in real life, again, the costs have come down significantly in recent years. But in real life, you'll find, therefore, that these things start to become expensive. A better way to do it is just to buy a cap or a collar from your bank. Right, that's interest rate futures. What you should be able to do, certainly for ACCA, ICAEW and so on, is you should now actually know you should be able to construct a question. And when I say construct a question, you should be able to answer a question. So how do we construct a hedge? How many do we buy and sell? Which month? and so on. And then how do we calculate the gain or loss on the hedge? And how do we match that with the gain or loss on the underlying interest? Once you can do these questions and you get your head around this block that people have about futures and options, they're actually very, very easy. And it's something where if you get it right, the examiner can't do anything other than give you 100% of the marks. For students that go away to fancy training companies, to the BPPs of this world, those students do this stuff very well. And that's why over time, certainly with an ACCA, we've seen from the old examiner moving on to new examiner, that they've started to put more into the questions about these things called agents, fees, deposits, margin calls and so on. So make sure you know those. Right, thank you very much for listening. Those of you who've listened all the way to the end. Hope you enjoyed it, it was interesting. Go get yourself some old questions, the internet's full of them. If you have any questions for me, please send them to the website rather than putting them up on YouTube. People are very good at that actually. They do send them to their website. Anything we can help you with, or any other topics like this that people find difficult at ACCA, give us a call. And if you have any friends you think it would be useful, please invite your friends. Like us on Facebook and love us and all the other stuff that everybody demands. Right, have fun and best of luck with your exams. I believe the CMA exams results come out today, so good luck to anyone waiting for those. Bye bye now.